Corporate finance practice problem using OneNote. Acquisition and tax carryover with even cash inflows. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side. We're looking at an acquisition type of situation. One company purchasing another for $2,500,000. The company to be purchased has a loss carryover, which may result in a tax benefit for the acquirer, because oftentimes the carryover cannot be taken until there's income in the future periods. And if we can match up that tax benefit or that carryover to income from the acquiring company, then that could be a tax benefit. We're going to say the tax rate is going to be the 30%. We have the potential cash inflow from investment. Cash inflow per year is going to be $310,000. So in other words, the acquired company is going to provide the acquirer a return on the investment of $310,000. We're going to assume that to take place over 16 years. Notice that's a nice even inflow that we're assuming. So that's going to be a more simplified type of scenario than if we were to say that there's going to be an uneven kind of inflow scenario, which we may practice in future presentations. We can then use an annuity calculation for that inflow. We're going to have the discount rate at the 12%. Note that this is going to be similar. We're going to use similar types of techniques here we had for our capital type of financing, long-term project type of financing. We're going to try to predict what the inflows and outflows are. We're going to use our present value types of calculations. We're looking at basically the net present value type of calculation here. So I won't go into a lot of the details for the different formats that we can use for net present value calculations here. You can go back to sections where we look at just simply present value and future value, time value of money calculations, and capital budgeting. Here we're going to do these calculations basically using the format of Excel formulas. All right, so we're going to say that the cash outflow is going to be then the payment that we're going to have, the payment which we're assuming is a one-time payment of the $2,500,000. And then I'm going to take into consideration the tax impact that we will have here, because once again, the company being acquired has that carry forward that could have a tax benefit for us of that $650,000. So I'm going to call that a tax loss benefit. So tax loss carryover benefit, and the company to be purchased had the loss, let's say the carryover, and I'm going to indent that was the $650,000. Now, assuming, of course, we can take that loss against income in this year, we're going to say that we're going to recognize that or get the benefit of it immediately. If we couldn't do that, we couldn't match it up and take it immediately, then of course we'd have to use our time value of money to determine when we're going to get that tax loss to be a cash flow benefit. Our goal here is to have the cash flow as our estimating tool so we can use our time value of money calculations for our decision-making process. Let's go ahead and say the tax rate is going to be the 30%. So we're going to get a tax benefit of the 30% of the $650 because we get to match the loss against our income. We're going to percentify that, go into the font group and underline that. That's going to be our tax benefit. So this is the tax loss carryover benefit. Going to double indent that by going to the alignment group, double indent, 2 times indent. That's going to be equal to the $650,000 times the 30%, or $195,000. Let's go ahead and underline that, font group and underline, and we'll call that the cash outflow present value, PV for present value. It's all in the present value because we're basically at time period 0 of the first year here. So the $2,500,000 minus the benefit we're going to have, it's going to cost us, in essence, the $2,305,000. Then we're going to look at the inflows that we have. And once again, we're estimating our inflows to be nice and even here at the $310,000. So we can use basically an annuity calculation. If they weren't so even, then we'd have to do present value calculations to determine different cash flows in the future, which we'll probably do in future presentations. Similar process we had with capital budget type of scenarios. We're going to be discounting using the rate of the 12%. Again, same kind of concept and theory we saw with the capital budgeting type of calculation, net present value calculation here. So I'm going to do an annuity formula This is something that we've seen both in present value calculations and in when we're calculating things like bonds and calculating the cost of capital budgeting type of decisions here. I won't do it with formulas. We're not going to do it with tables. We're just going to use the Excel formulas in this case. If you want to look at those present value calculations in multiple different formats, take a look at a prior presentation. We will also be doing these a little bit quicker here, not spending so much time on just the calculation of the present value. So the formula is going to be negative present value, shift 9. We're going to have the rate, which is going to be that 12% per year, comma, the number of periods. We're going to say 16 years. Notice we had to estimate some portion or period in the future. We're going 16 years out. We're going to say comma, and then I'm picking up the payment instead of present value of 1, which would be the future value here, because this will be an annuity calculation, present valuing that $310,000 we're assuming to be getting from the acquisition over the 16 years, discounting it at the 12%. That gives us the $2,161,936. If we subtract the 2 out, the inflow is going to be, I'll do it this way, the inflow is the $2,161,000. The outflow is the $2,305,000. So we have a negative amount here for the net present value, meaning the outflows are greater than the inflows when we present value them. Therefore, we would assume here not the project we want to pick because it's not clearing the rate of the 12%. And again, the rationale for this would be the same for the capital because we're doing the net present value calculation. So if it was 0, then or anything above 0 for the net present value, then we'd be clearing the 12%. Kind of you can think of as the hurdle rate, the cost of capital, the discount rate, and therefore might be a beneficial thing to do, even though a 0 then, in other words, does not necessarily mean that that's the return we would be getting. If it was at 0, that would mean we're getting a 12% return. And once again, that 12% would be assuming that that includes the rate of return we're looking for. So anything above that amount would be something that might be beneficial for us. So if it was 0 or above, could be beneficial.